Hi everybody, this is Ellman with today's option selling question of the day. Today's question comes from Barry. Alan, I am evaluating the recent member reports for covered call writing. Since it is earnings season, I turned to the ETF report. I noticed 1 month returns for ICLN, PBW, LIT, and YOLO ranged from 6.4% to 9.1%. This doesn't make sense that the RU is so high. What am I missing? And are these safe to use? Thank you, and it's signed Barry. Well, certainly it's important that we understand the significance of these high premium returns for 1 month near the money strikes. So let's start off by analyzing how we interpret these 1 month time value returns, which range from 6% to 9% for these near the money strikes. First, we have to understand that time value is directly related to the implied volatility of the underlying securities. Now, implied volatility is the market anticipation of the price movement of a stock or ETF up or down. It doesn't really tell direction. Usually it's over a 1-year time frame and based on one standard deviation, so the range is supposed to be accurate about 68% of the time. Now, the good news is the greater the implied volatility, the larger the premiums that we receive. But the bad news is these larger premiums mean that we're undertaking much greater risk. So what we must do is establish an initial time value return goal range before entering a trade. And that range must align with our personal risk tolerance and strategy return goals. Now, for me, it's 2 to 4% a month for 1 month near the money strikes. I will go up to 6% for 1 month returns in a very strong bull market, but never higher because I'm not willing to undertake the risk of a higher implied volatility security. So one size does not fit all. And again, this range is dependent on what our personal risk tolerance is. So it'll vary from investor to investor. Okay, next, let's have a look at that BCI ETF report that Barry was alluding to. And let's have a look specifically at the implied volatility column and see where these securities lie. You can see at the very top that the implied volatility of the market as a whole on that date, the S&P 500, was 18.35%. So that gives us a frame of reference. Now look at the implied volatility of the 4 securities that Barry had mentioned in his question. It ranged from 56.92% for LIT, and we'll have a look specifically at that ETF, up as high as 73.56 for ICLN. So LIT had a 56.92, which is more than triple that of the S&P 500. So now it becomes pretty clear why those initial return on the options was so high, as Barry had pointed out. Now, is there a way that we could stay with these securities and mitigate most or all of the risk affiliated with these high implied volatility securities? Well, let me take it back. We will never get rid of all the risk, but we can get rid of a lot of the risk by selecting in the money strikes. And let me explain how that works. And in the money strike, the premium will generate both time value and intrinsic value. Now, the intrinsic value component is the amount that the strike price is lower than current market value. Now, at the money and out of the money strikes do not have an intrinsic value component to the option premium. And that's why the in the money strikes give us greater downside protection because of that additional intrinsic value component of the premium. Now, on the downside, we will not benefit from share appreciation because when we sell an in-the-money strike, we're agreeing to sell our shares at a lower price than the security is currently trading for. And therefore, we don't benefit from any share appreciation. So once again, there are pros and cons, and we have to target what we're specifically looking for. So what we're going to end up doing with these in-the-money strikes, and specifically going to go deep in the money, is we're going to lower our initial return on the option, time value component. We're going to lower that from the 6 to 9% down in this hypothetical to 2 to 4%, where I'm personally more comfortable. And we're going to get greater downside protection or lowering our break even much, much more because we now have an intrinsic value component to that option premium. All right, well, to kind of make this all come alive, let's actually go to an option chain. This is a CBOE.com option chain. At the time, LIT was trading at 68.30, so we're going to look for strike prices well below that for a deep in the money strike. And if we look on the right side of the spreadsheet, you can see here that LIT had a 61 strike, which generated a bid price on the left side of $870 per contract. Now, is that all profit? Absolutely not. Why not? Because we're buying the security at 68.30 and agreeing to sell it for 61. So we're losing $7.30 per share on the sale of the stock or the ETF. So we have to deduct that from the 870. Now the calculators will do that for us. So let's feed this information into the multiple tab of the basic Ellman calculator or the Elite calculator or our best Elite Plus calculator. And look at the multiple tab and we find the following results. If we purchased LIT at 68.30 and sold the 61 strike at 870, the time value return, that's deducting the intrinsic value, is 2.3%. And that's for a 1 month return. If you annualize that, it would come out to about 28%. Not bad. Now, once again, upside potential is zero because we're agreeing to sell our shares at a lower price than the security is currently trading. However, we have downside protection, thanks to the intrinsic value, of 10.7%. So what that means is the following. We are guaranteed a 2.3% 1 month return as long as share value does not decline by more than 10.7% by contract expiration. And there you have the advantage of the in-the-money strike, which will help mitigate the risk of a high volatility security. Let's summarize. High volatility securities result in higher premiums, but greater risk. The risk can be mitigated by using deep in the money call strikes and taking advantage of the intrinsic value component. Now, the time value of that premium must align with our established goals, which we established prior to entering the trade. And that strike selection must align with our personal risk tolerance and our initial time value return goal range. So once again, we must establish the parameters before we enter the trade. Once the trade is entered, we immediately enter our 20%, 10% guidelines, buy to close limit orders. For a monthly option, it would be 20%, and that's entered immediately after the covered call trade is executed. Okay, before we close, I just want to remind everybody that the entire library of Ask Alan videos is available only on our premium member site, now 189. We add a new one every single month. We've been doing that for years. The titles are located on the right side of the member site in the resources download section. Just scroll down to A for Ask Alan titles, and you will have access to all 189 and growing number of Ask Alan videos. I also want to remind everybody of our BCI package, which is an acronym for our best and most comprehensive investment package ever offered by BCI. It includes so much: 6 online video courses, 6 calculators created by BCI, 5 of our best-selling books in ebook format, an annual premium membership, which is 13 months of membership, which has about 20 different perks to them, including our member reports and much, much more, including these Ask Alan videos. So the BCI package is available on the site. Just click on the BCI package link you see on all of our web pages, and it's available at a 20% discount, total $9.97 for all the items I just mentioned. Once again, our best and most comprehensive investment package. So, ladies and gentlemen, I want to thank you so much for taking the time to watch and listen to this Ask Alan video. I also want to thank Barry for sharing the question with our BCI community. It was an excellent one, Barry, so thank you so much. I hope this information not only benefits you, but I hope you enjoyed this presentation as well. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.